Okay, let's dive in. We're taking a deep look at Bank of America's latest results, that really strong third quarter of 2025. And maybe more importantly, what management's saying about their strategy going forward. Our mission today is kind of cut through all the numbers and figure out what's really driving their success.
Yeah, the big message from BAC management seems to be, look, performance is good, but this is just the start. They keep talking about closing this relative value gap, basically proving they can grow sustainably business by business. It's not just about riding the wave of rate hikes. They want to show they're an efficiency and tech story, too.
Right, that distinction rate beneficiary versus like an efficiency machine, that's exactly what we need to explore. Because the headline numbers, I mean, wow, they were undeniably strong. Let's start there. Total revenue hit $28.1 billion. That's up a very healthy 11% year over year.
And the bottom line grew even faster, which is key. Net income jumped 23% to $8.5 billion. That pushed EPS, earnings per share, up 31% to $1.06. But the number they seem most focused on right now is the efficiency one.
Ah, the ROTCE, return on tangible common equity, their favorite metric.
Exactly. ROTCE tells you how well they're using shareholder money. It jumped pretty dramatically to 15.4%. That's up from 12.8% just a year ago. Hitting 15% was kind of a big deal psychologically for the stock, I think. And management's already saying, hey, 15% isn't the end goal. It's more like a new baseline.
You don't get returns like that without keeping a really tight lid on costs, though. I was struck by the operating leverage number.
Yeah, 5.6% operating leverage, which basically just means their revenue grew a lot faster than their expenses. Expenses grew about 5%, so revenues outpaced that significantly. And this discipline pushed their efficiency ratio, how much it cost them to make a dollar below 62%. That really signals a very efficient operation.
And all that profit lets them keep a strong balance sheet and reward shareholders.
Right. Absolutely. Their main capital measure, the CET1 ratio, was 11.6%. That's well above the 10% minimum regulators require. And they put that strength to work, returned a huge $7.4 billion to shareholders just in Q3. That was split between dividends and a big $5.3 billion stock buyback.
Okay, so great quarter confirmed. Let's dig into the foundation of that profit. Net interest income, NII. BAC reported record NII. When you adjust it for tax stuff, NII FTE, it hit $15.4 billion, up 9% year over year. Where's that strength coming from? Because, the Fed's kind of stopped hiking rates for now.
Right, and this is where the story gets, really interesting. And it's a big reason why the market seems to like their guidance. The NII strength comes from two main things. First, good old-fashioned core growth loans and deposits. But second, there's this massive, almost mechanical boost that's pretty much locked in.
Mechanical boost. Tell me more. Is that tied to their older fixed-rate stuff?
Exactly. Think of it like this. They have this huge pile of assets, like mortgage-backed securities and loans that they bought years ago when rates were basically zero. Now those low-yielding assets are maturing or rolling off the books.
Ah, so they get to replace them with new assets bought at today's much higher rates.
Precisely. And it's not a small thing. They called it a multi-year phenomenon.
Yeah.
They expect somewhere between $10 billion and $15 billion of these mortgage assets each quarter to roll off in 2026. And the new assets replacing them will yield, say, 1.5% to 2% higher. That gives them this structural, almost guaranteed lift to NII, regardless of what the Fed does next.
That kind of certainty sounds great for their forecasts. It de-risks things a bit. But I wonder, does relying on assets rolling off kind of mask weakness and actual new loan demand? How's the core growth looking?
That's a fair question. And management would say the underlying organic growth is still solid, which is why they're optimistic. Average loans were up 9% year over year. That's $1.15 trillion. Commercial loan growth was particularly strong, up 13%. And they said every single business line, consumer, corporate, everything saw higher average loans.
And deposits. That's always been a Bank of America's strength, right? Their relationship banking focus.
Oh, yeah. They really dominate on deposit pricing. Average deposits were up 4% year over year, hitting $2 trillion. But they're all about the quality of those deposits' core customer money. Their consumer bank just booked its 27th straight quarter of net new checking account growth, added about 212,000 this quarter alone.
And what they pay for those deposits is pretty amazing. The rate paid on total deposits actually went down 32 basis points year over year. For consumer deposits specifically, the rate paid was just 58 basis points, 0.58%. That's incredible pricing power.
It really is, especially when you see other banks paying, 5 times that much or more for funds right now. So you have this dual engine, solid core growth, plus that mechanical repricing lift. And that combo underpins their strong NII guidance. They expect Q4 NII to be at the high end of their previous range, so $15.6 billion plus. And looking out to full year 2026, they see NII growth kind of similar to 2025, maybe in the 5% to 7% range.
Okay, let's switch gears from NII to fees, because the fee businesses really came back strong in Q3. Looks like capital markets might be waking up.
Yeah, they had three big fee areas just firing on all cylinders. Investment banking fees up a massive 43% year over year, over $2 billion. Management actually called it the highest non-pandemic fee quarter ever for the firm. That's saying something. Plus, they said the pipeline is up double digits, so that suggests momentum carrying into next year.
And their global markets division, sales and trading, just keeps churning it out.
It's relentless. S&T revenue grew 8% year over year. That makes it, 14 quarters in a row of year-over-year growth? Getting that kind of consistency in such a volatile business is pretty unusual.
Yeah, it really is.
Shows they've consistently invested in that platform, right? Within S&T, FICC, that's fixed income, currencies, commodities, was up 5%. Equities trading did even better, up 14%. And then asset management fees also had a good quarter, up 12%, helped by strong markets and good client inflows. AUM flows were $84 billion over the past year. So yeah, the fee side is definitely back and adding important diversity to revenue.
All right, now let's get to the core strategy bit. How are they planning to grow each specific business line? To make sure this isn't just, a cyclical peak driven by rates and market bounces, what are the key growth initiatives they're funding?
They laid out pretty clear plans for each of the four main segments, mostly focused on cross-selling and just deepening relationships. In consumer banking, it seems like two big things: a renewed push on payments to drive checking account growth, and using digital marketing really aggressively for personalized offers, trying to boost digital engagement.
Okay. And for the wealthier clients, Global Wealth and Investment Management, GWAM.
There, it's all about getting net new relationships, driving those asset flows like that $84 billion AUM number we just mentioned, and crucially, getting more banking business from those wealth clients. They said 63% of GM clients now have a banking relationship with BAC. That's key for stickiness and maximizing the value of each client.
Makes sense. What about the big institutional businesses, global banking and global markets? They
Yeah.
always need heavy investment.
Yeah, for global banking, growth seems to come from two areas: just doing more with the big companies they already serve, and also really pushing into the middle market investment banking space. They mentioned adding bankers in local markets to grab that regional IB business where maybe it's less competitive than Wall Street. Global markets, it's more of the same steady investment: tech, people, balance sheet capacity, especially focusing on lending to big investors and trying to capitalize on all the growth we're seeing in private markets.
Let's talk about that tech investment more. It seems key to the operating leverage story we discussed earlier.
Yeah.
Applied technology, AI. We really need to focus on Erica, their virtual assistant. That seems like the biggest AI win so far.
Oh, absolutely. Erica isn't just some pilot program. It's deployed at serious scale. It's a real competitive advantage. Get this: 20 million customers use it. It's handled 3 billion interactions since it launched. And right now, it handles 2 million customer interactions every single day.
2 million daily.
Yeah.
Just staggering.
Yeah.
It means millions of routine questions, basic tasks, handled without a human, which must save.
Thousands of labor hours, exactly. It drives customer satisfaction, makes things stickier, and dramatically cuts the cost to serve. And they've managed to use that same tech successfully for business clients and even internally. They rolled out Cash Pro Chat for commercial clients. Now, 65% of clients using Cash Pro do 40% of their interactions via chat.
And internally, how does it help their own employees be more efficient?
Same idea. They said 90% of employees use Erica for internal questions, think HR stuff, IT help. That saves huge amounts of time for the central service desk. Even their coding teams are seeing benefits. Using AI tools like GitHub, they're seeing time savings of maybe 15–20%. So this is real measurable efficiency deployed at scale. It feeds directly into that strong operating leverage we saw.
That efficiency focus really explains the expense outlook then. Q3 expenses were $17.3 billion, up a bit from Q2, but the guidance looks pretty tight.
Yeah, they're guiding Q4 expenses to be flattish compared to Q3. And a big reason is headcount is also expected to be flat. In fact, they've actually brought headcount down from a peak of around 217,000 to 213,000 now. That underscores the tech efficiency gains. Management basically said any upward pressure on expenses is mostly coming from bonuses tied to those strong fee businesses like IB and trading, which, is good expense because it's directly linked to bringing in more revenue.
Okay, one last check on the financials before we move on. Credit quality. With the economy still a bit uncertain, any warning signs in the loan book?
Overall, things look pretty solid. Consumer credit actually seems quite resilient. Consumer credit card losses net charge-offs actually decreased by 10% from Q2 to Q3, down to 3.46%. Commercial asset quality also looks strong across the board. There's really only one well-known issue.
Let me guess. Commercial real estate, office properties.
Bingo. That's been the persistent worry for the whole industry, hasn't it? BAC is actively managing it down, reducing the size of that office loan book. And they noted that non-performing loans, NPLs, in that specific segment are actually starting to come down, so its overall impact is lessening. Outside of CRE office, they didn't really flag any other major areas of concern in the source materials.
All right, let's zoom out finally to the really high-level stuff. Capital deployment and the regulatory world. Always a moving target for a bank this big.
Their priorities on capital seem crystal clear. Number one, fund that organic growth we talked about. Only after that comes returning capital through dividends and buybacks. The buyback run rate is currently about $5.25 billion per quarter. On the regulatory side, they sounded somewhat encouraged by recent talk about changes to the supplemental leverage ratio, the SLR.
And the never-ending story of Basel III getting finalized.
Yeah, that's the big one. Getting those Basel III rules finalized is key. It's been dragging on since, 2017? 8 years now? Management did raise a couple of specific technical worries. First, this risk of double counting. They're concerned the rules might force them to hold capital for the same risk twice, once under Basel III, and again under the Stress Capital Buffer, or SCB.
Wait, double counting risk.
Yeah.
What does that mean in simple terms? How does it hurt them?
It basically means the proposed rules might make them set aside capital for, say, market risk under one rule, and then set aside more capital for essentially the same market risk under a different rule, the SCB. It's inefficient. It ties up capital that could otherwise be used for lending or returned to shareholders. The second point was about fixing the GSIB buffer calculation.
Right, the extra capital buffer the really big, globally systemic banks like BAC have to hold.
Exactly. Their suggestion was either simplify it, just use the method 1 calculation like the rest of the world does, or if they keep the current method 2, they need to index it for inflation and economic growth. Because right now, the way it works, the buffer automatically goes up just because the economy grows, which penalizes banks simply for getting bigger along with GDP.
Okay, this has been a really thorough dive. So, to some of the biggest takeaways for you listening. BAC didn't just meet expectations, they crushed them with that 15.4% ROTCE. A big driver is this almost guaranteed NII growth coming from old low-rate assets rolling off and being replaced by higher-yielding ones. It's a multi-year tailwind.
And that financial strength is underpinned by technology, especially AI like Erica, being used at massive scale. Remember, 2 million customer interactions handled daily. That directly fuels their efficiency and helps them keep deposit costs incredibly low.
It paints a picture of really strong execution and leveraging their scale effectively. But the question is always about sustainability, right? How long can that 15% plus ROTCE last?
Which brings us right to our final thought for you to consider. We know that NII growth they project for 2026, that 5% to 7% range, is a mix. It's part mechanical lift from asset repricing and part actual core loan growth. The big question looking further out is this. Once that multi-year mechanical boost from repricing starts to fade in, say 2027 or 2028, how strong will that underlying organic loan and deposit growth really be on its own? Can that core growth sustain ROTCE above 15% long term? That organic engine, not just the mechanical swap, is where the focus really needs to shift over the next few years.